Welcome students, welcome to lecture number 26 where we will be covering module 4 income from capital gains under subject direct taxation. Under this module, as we know as per VTU syllabus, we have basis of charge, transfer of capital asset, inclusions and exclusions from capital asset, capital gain, computation of capital gain, which we have covered in yesterday's lecture number 25. But computation of capital gain is a very huge part. We have lots of things to cover under that. So today we will be continuing with the computation of capital gain. So as we know, capital gain is nothing but gain arising from transfer of capital asset. We know there are two types of gain, short-term capital gain and long-term capital gains. Short-term capital gain is a gain arising from transfer of short-term capital asset, whereas a long-term capital gain is a gain arising from transfer of a long-term capital asset. We know what is short-term capital asset. We already know what is a long-term capital asset. Now, yesterday we had seen that if a particular asset is falling under a long-term capital asset, indexation benefit is given to the long-term capital asset. But here we are going to see in this particular slides some cases where indexation benefit is not available even on transfer of a long-term capital asset. So there are certain situations, certain cases where even if that asset is categorized as a long-term capital asset, indexation benefit will not be given to these particular cases or these particular assets. So debentures or bonds. So if there is a transfer of any bond or debentures, okay, other than indexed, capitalized index bonds that are issued by the government, other than that, if they're other than the debentures or bonds that are issued by the government, okay, or issued by the RBI under the sovereign gold scheme, if these, apart from that, any debentures which are being transferred and if they are long-term capital asset, indexation benefit will not be given if it is a transfer of a debenture or bonds. Next is slump sale. Now, what is the meaning of slump sale? First, let us understand. Slump sale means nothing but when you are transferring one or more undertaking, okay, and you're selling that undertaking, one or more undertaking, for a lump sum consideration. Means as a whole amount you're selling that without valuing or without assigning values to separate assets or individual liabilities. You're not going to remove the value like that. In a lump sum consideration, you're going to sell off the undertaking. So when there is a transfer of such undertaking, so when this is in short called slump sale. So when there is a transfer of an undertaking or division in a slump sale, where the transfer is happening for a lump sum consideration without assigning individual values to the assets or liabilities in such sale, then indexation benefit will not be given even if it is a long-term capital asset. Next we have is equity shares or equity oriented fund referred in section 112A. Now what is 112A section? We have a complete separate lecture for this, a complete separate thing that we have to go through. So just remember for now, whatever equity shares and equity oriented funds are being transferred, only those funds or those equity shares that are being referred in this section, if they are transferred and if they are categorized as long term, indexation benefit will not be given. If indexation benefit is not given, means they have to be computed as if they are short term capital asset. Next, certain transactions by a non-resident. So suppose in case of a non-resident, whatever capital gain is arising on the transfer of shares or debentures of an Indian company, okay, acquired in foreign currency. So suppose if any non-resident is purchasing the transferring the shares of an Indian company which he had purchased in the foreign currency. So those transactions, though if it is falling as a long term, you have to not give the indexation benefit. Next, transfer of global depository receipt. Now, when any global depository receipt has been transferred, but it was purchased in the foreign currency by a resident individual, okay, being employee of an Indian company, if all these conditions are meeting, then the transfer of global depository receipt, if it is categorized as a long-term capital asset, indexation benefit will not be given. Now, global depository receipt, you all know it is a bank certificate that is issued by more than one country for the shares in the foreign company, correct? So if an Indian company, employee of an Indian company who's an individual resident, he is investing, he's purchasing those GDRs in foreign currency and then transferring those GDRs, if it is categorized as long-term capital asset, then indexation benefit will not be given. So students, I hope you'll have understood this slide. Just remember that if these are the cases, even if it is long term, please don't give the indexation benefit. Like, please don't calculate what is the indexed cost of acquisition or indexed cost of improvement. There you have to just write cost of acquisition, cost of improvement. That is it. So have you all understood this particular slide, students? Yes?
Yes, ma'am.
Okay. Next. Now, this is a other concept in computation of income from capital gains. Now, what is deemed or notional cost of acquisition? Students, can you tell me what is cost of acquisition? Can anyone tell me what is cost of acquisition? Forget what is deemed or notional. Just tell me what is cost of acquisition. What is the meaning of cost of acquisition? Quick, students.
The price which we have purchased the asset, the price of the asset.
So the price at which the asset is acquired or the purchase cost of the asset, correct? Okay. Now, what if the asset, capital asset, is given as a gift? Then what will be the cost of acquisition? What if a capital asset is acquired in liquidation? Liquidation, you all know what is liquidation. So what will be the cost of acquisition? What if the capital asset is acquired by the SEC under a will? You all know what is a will, right? Under a will or under the partition of an HUF. HUF is getting divided and whatever assets are there, it has been distributed among the members. So in those cases, what will be the cost of acquisition? So in those cases, the cost of acquisition will be deemed or notional cost of acquisition. Are you all understanding when deemed or notional cost of acquisition will come? When the exact cost of acquisition to the SSC never arises. Suppose I have received any capital asset as a gift. So have I acquired it by giving some price? No. Then what will be the cost of acquisition in those situations? So first, let us see the situations where notional or deemed cost of acquisition will arise. So first, asset received on total or partial partition of HUF. Okay, when HUF is getting divided, whatever asset is received, it will be received without any consideration. Then what are you going to take cost of acquisition? Next, assets received under a gift or will. Assets received by succession, inheritance or devolution. Assets received on dissolution of a firm, BOI or AOP. Assets received on liquidation of a company. Assets received under a trust, whether revocable or irrevocable. Assets received under business reorganization subject to certain conditions. Asset received by an HUF from its member. So students, did you all understand that in all these 8 cases or situations, there is no cost of acquisition. There is no actual cost of acquisition because they have received that particular asset. The SSC is receiving these assets in these situations without any consideration. So then when suppose that SSC is selling that asset in future or transferring the asset in the future, what is going to be the cost of acquisition that you are going to consider? So students, the cost of acquisition of the previous owner of the property shall be deemed to be the cost of acquisition for the SSC. So what does this mean? That in these 8 situations, the cost of acquisition that you have to consider will be the cost of acquisition that the previous owner. Now suppose assets received under a gift or will. My uncle had a capital asset and he had purchased it for some particular cost. He gave me it as a gift. Okay. So whatever cost uncle, that is a previous owner, is a person who's receiving, who's holding the property. Okay. Last property, who's holding the property before me. So whatever cost the uncle had incurred for acquiring the property will be the cost of acquisition for me as well. So only in these 8 situations, remember students, that the cost of acquisition of previous owner is the cost of acquisition that you have to take while computing the income from capital gains. Now, what is previous owner? As I already told, means the last owner who acquired such asset through a mode other than the modes mentioned above. So mode other than the mode mentioned above is other than these 8 modes, through whatever mode, if the previous owner has acquired the property, obviously it will be for consideration. So whatever cost he had incurred for acquiring the property, the same cost of acquisition I shall take it while calculating, while I'm transferring the particular capital asset. That is why it is called deemed or notional cost of acquisition. Have you all understood this concept, students?
Yes, ma'am.
Everyone has got it? What is the meaning of deemed or notional cost of acquisition?
Yes,
Yes,
ma'am.
Okay.
ma'am.
Now, yes. Now, let us see the terms that will be used in case of deemed cost of acquisition. Now, suppose cost of acquisition of an asset, where cost of acquisition of the previous owner is ascertainable. See, now suppose if I am receiving a capital asset as a gift, okay, and I am transferring it. So when you know I am transferring means what will happen? I have to compute capital gains. There is one concept called as cost of acquisition. Now, since I've received it under the will, so as a gift, I know that whatever cost the previous owner has incurred, that is the cost I'm supposed to take. I go to the previous owner and ask him what is the cost of acquisition. If he says, if he knows the cost of acquisition, I can compute the cost of acquisition, then it is ascertainable. I know what is the cost of acquisition of the previous owner. Then what is the cost of acquisition you're going to take? Cost of acquisition of previous owner, since it is ascertainable. What if it is not ascertainable? Where cost of acquisition of previous owner is unascertainable, means I am not able to determine, or I'm not able to get what is the cost the previous owner incurred to purchase the capital asset. In that situation, the fair market value of the asset on the date on which the previous owner had acquired the same shall be deemed to be the cost of acquisition. So there are two things here, students, where you can identify what is the cost of acquisition of previous owner, then you take that particular cost as cost of acquisition. Suppose you're not able to identify, then you take the fair market value on the date when the previous owner had purchased the property, capital asset, as the cost of acquisition. So have you all understood this particular first two rows? Yes, students? Students, are you all there?
Yes, ma'am.
Okay, next. What is the cost of improvement then you're going to take in such situations? Suppose what happens is you have got any particular capital asset under a will, okay, and you have made certain improvements on that. You know what is improvements, which will increase the value of the particular asset, okay, improve the quality of that asset, where that expenditure is in the capital nature, correct? So you also have incurred some expenditures. whereas the previous owner also had made some improvements. So cost of improvement shall include improvement expenditure incurred by the previous owner. So the cost of improvement also includes improvement expenditure incurred by the previous owner. So previous owner, if he's done any improvement on the asset, that is to be considered under cost of improvement. Next, period of holding. How period of holding? How will you classify whether a particular asset which is falling under the deemed cost of acquisition is short term or long term? So, period of holding of previous owner shall be considered for classifying the asset into short-term or long-term capital asset. So, even in case of period of holding, you have to determine the holding period of the previous owner as well. For how much period the previous owner was holding the asset, based on that, you will classify it as short-term or long-term. Next, indexation benefit on cost of acquisition. What is going to be the indexation benefit? Indexation benefit shall be from the year when the current owner first held the property. So so indexation benefit means that CII, what you cost inflation index. So that you have to consider from the year when the current owner first held the property, not the previous owner. So when the current owner is holding the property, you have to consider that particular year for the indexation. So how do we I just want a quick answer. How do we calculate indexed cost of acquisition? What is the formula, students? Students, I request you all to mute your audios. Those who want to answer, please unmute it. So can anyone tell me how do we calculate indexed cost of acquisition? In our yesterday's lecture, we have seen it. How do we calculate index cost of acquisition? We take cost of acquisition into the index of the year of transfer divided by the index for the year of acquisition. So your index for the year of acquisition will be the index when the current owner first held the property. Next, indexed benefit on cost of improvement will be indexation benefit shall be available from the year when the previous owner did the improvement. So in case of improvement, you have to take index of the year of when the previous owner did the improvement. And in case of cost of acquisition, you have to take the index of the year in which the current owner acquired the property actually under deemed or notional cost of acquisition. So this particular slide you will understand better when we solve problems relating to deemed or notional cost of acquisition. Then you can see how this theory part is practically put into the solving the problems. So did everyone understand? First of all, till now we have seen two cases. Case number one, what are those cases where indexation benefit will not be given even though if it is a long-term capital asset? And second, we have seen cases where we cannot use cost of acquisition, but we have to use deemed or notional cost of acquisition. So now moving ahead to third concept. Third concept is notional sales consideration. Now can anyone tell me what is sale consideration?
Sale value of asset.
Students, can you?
Sale value of an asset.
When you're selling the asset, whatever value you're receiving in money or money is worth. Now, what do you mean by notional sales consideration? Sometimes you are receiving some, you are transferring your capital asset, but you are receiving some consideration. Okay, there are some situations where you're receiving some consideration where it is not actually the sale that you're making. Okay, there are certain cases where there is no actual sale. In those but still you're receiving some consideration, some compensation. In those cases, you have to take the sales consideration as notional sales consideration. Let us see those cases. In some cases, notional sales value is considered rather than actual sales value. So these are the different types of situations, 7 situations or cases where you're going to take notional sale consideration as the sale consideration and not the actual sale value. So first, insurance claim received on damage or destruction of a capital asset. So when your capital asset has been damaged or has been destroyed, okay, so in that particular situation, what happens? Capital asset is gone, but you are receiving some compensation from the insurance company. So what will be your deemed value of consideration? Compensation received in cash or fair market value of the asset received as compensation. So whatever compensation you're receiving from the insurance company, that will be the deemed value of consideration. Next, conversion of capital asset into stock in trade. See, we know that all this is amounting to transfer when you're converting your capital asset into stock in trade. So what is going to be the consideration? See, it is nothing but transfer. You're transferring a capital asset into stock in trade. So it amounts to transfer. There is a capital asset, means there has to be a capital gain. To compute capital gain, you require sales consideration. Now, in this case, what is going to be the sales consideration? Fair market value of the asset as on the date of such conversion. Next, when you're transferring the capital asset by a partner or member to a firm AOP BOI as capital contribution. Suppose I am a partner in a partnership firm, or I am a member of an AOP BOI. I want to transfer my capital asset into the firm. Correct. So what is going to be the sale consideration? I'm not going to get anything in return because AOP BOI is not purchasing it. I am transferring it as a capital contribution. Then the deemed value of consideration that I have to consider will be the amount recorded in books of accounts of the firm AOP BOI as value of such asset. Similarly, we have remaining situations. Transfer of capital asset by a firm AOP BOI or partner to a partner member by the way of distribution on its dissolution. Again, you have to take deemed value of consideration as fair market value of asset as on the date of transfer. Next, assets received by shareholders on liquidation. So money so received or the market value of other assets on the date of distribution as reduced by the amount assessed as dividend. Next, shares, debentures or warrant transferred by an employee by way of gift or under an irrevocable trust. So market value of the asset as on such date of transfer will be the deemed value of consideration. Next, transfer in case of land, building or both. So value determined for payment of stamp duty if consideration is declared less by the assessing. So students, among all these cases, the important ones or what is majorly asked in the exam is conversion of capital asset into stock in trade. Problems on this is asked, or transfer in case of land, building or both. So majorly questions are asked based on conversion of capital asset into stock in trade and transfer of land, building or both. So we'll be concentrating on those where importance is to be given more. So this transfer in case of land, building or both, what happens is many a times the SSC shows a very less value. Okay, so he is subject to less capital gains. But if the value declared by the SSC is less, then the deemed value of consideration that you have to consider is the value determined for payment of stamp duty. So let us now individually see these cases and solve problems on each case so that we understand the concept properly. So today I think we'll be able to cover only insurance claim and conversion of capital asset into stock in trade. Let us in detail see this. So when any insurance claim is received on damage or destruction of a capital asset, okay, suppose I have a capital asset, it has been destroyed, it has been damaged, okay, then what is going to be the sales consideration that I have to consider? Remember students, any compensation that is received from an insurance company, okay, for some specified damages, no, not all the damages. Suppose if damages is caused by flood, okay, by cyclone, by earthquake or any natural calamities, or by any fights, civil fights that are happening, by accident, fire, or by some action by the enemy. So if by all these reasons damage is happening to my capital asset, then only the compensation that I'm receiving from insurance company will be liable to capital gain tax. So in that case, what is the sale consideration I'm supposed to consider? If compensation is received in cash, compensation so received. If I'm receiving the compensation in kind means other than cash, then fair market value of asset received as compensation. So we know to calculate capital gains, we have sale consideration, we require expenses on transfer, cost of acquisition, cost of improvement. So we know now what is the sale consideration we are supposed to take if it is an insurance claim. Compensation received by the insurance company will be the sale consideration. Next, cost of acquisition, cost of improvement, and expenses on transfer will be as usual. As usual means we have seen today, whatever is the actual cost of improvement, actual cost of acquisition, actual expenses on transfer, that we have to take as usual. There is no change in that. Indexation benefit will be available if any, suppose if it is a long term, categorized as long term, it will be till the year of destruction. Always indexation benefit we get till the year of transfer, but here in case of insurance claim, it will be till the year of destruction. Next, taxable. In which year it will be taxable? It will be taxable in the year of receipt of compensation. The year when destruction takes place, it is not liable to tax. The year when you are receiving the compensation from insurance company, in that year it will be liable to tax. Tax rate is depending on the rate applicable in that particular year, you are going to charge the tax rate. So this in detail we have seen that in case of insurance claim, what is going to be the sales consideration, cost of acquisition, cost of improvement, expenses on transfer, what is the indexation benefit from up to which year you will get it, and which year you are going to tax it. Next is capital gains on conversion of a capital asset into stock in trade. Students, now remember this. When you're converting your capital asset into stock in trade, it gives rise to two set of income. One income which is taxable under the head capital gains, other income that is taxable under the head business income. So first let us understand capital gains. So the year when you're converting your capital asset into stock in trade, okay, that year it will not be liable to tax, but it will be liable to tax in the year in which the stock in trade has been sold. So remember that year you have to calculate capital gains. Now to calculate capital gains, you require sales consideration, you require cost of acquisition, cost of improvement, and expenses on transfer. So let us see what are we supposed to take. The sale consideration will be fair market value as on the date of conversion. So when you're converting the asset from capital asset into stock in trade, that date, what is the fair market value, that will be the sale consideration. Cost of acquisition, cost of improvement, and expenses on transfer will be as usual, no change. Indexation benefit will be available only up till the year of conversion. Only up to the year that you're converting the asset, till that year only indexation benefit will be available. And when it will be taxable, it will be taxable in the year in which such stock is actually sold. So the year when you're converting it, you need not show it as a capital gain, but the year your stock in trade is getting sold, that is the year when you will compute two set of incomes: income from capital gains that we have seen how to compute, tax rate as applicable in the year of actual sale of such stock. Now, when you're selling the stock is nothing but your unsold goods. So when you're selling the stock, obviously there is going to be a business income also. So treatment of difference of actual sale value and fair market value as on the date of conversion. So suppose you're selling the stock at 50,000 and the fair market value as on the date of conversion is suppose 40,000. So the difference will be your business income. So remember, your business income will be when you're selling the stock, because stock is related to your business. It is not a capital asset anymore. So how do you identify what is the profit or loss on the stock? Your whatever actual value you're selling the stock minus the fair market value of that stock as on the date of conversion. If you minus the both, you will get the business income, and this business income will be liable to tax under the head profits and gains from business or profession. So once again, this is very, very important, students. Once again, I'm repeating this particular concept. When any capital gain is arising on conversion of a capital asset into stock in trade, means it is a transfer, okay, then it is liable to capital gain tax. So your two set of incomes will arise. One is a capital gain, one is business income. Now, capital gain and business income, both you will compute in which year? In the year when your stock is actually sold. Okay. Now you know that in case of capital gains, you have terms to compute like sale consideration. What is the sale consideration you're going to consider? Fair market value as on the date of conversion. Cost of acquisition, improvement, expenditure as usual you're supposed to take. Indexation you will get not up to the year of transfer, but up to the date of conversion. Taxable in the year in which actually it is being sold. And what is going to be the business income? The stock, the actual sales value of the stock minus the fair market value as on the date of conversion. Difference, if it is positive, it is a gain, it is a business income. If it is negative, it is a business loss. So always remember, conversion of capital asset into stock in trade will give rise to two set of incomes under two different heads of income. So students, have you all understood this portion? We will be seeing problems on this today so that you understand the concept properly. Have you all understood this?
Yes, ma'am.
Okay. So whatever concepts we have seen today we have seen three different concepts, students. What are the three different concepts that we have seen? First concept, we've seen that indexation benefit will not be available even if it is a long-term capital asset for some specified assets. Okay. So we have to do the calculation considering that there is no indexation to be given normally, how we do for short-term capital asset computation. Similarly, we have to do long-term. The second concept, what we've seen, that deemed or notional cost of acquisition is nothing but the cost of acquisition of the previous owner is to be considered. And third concept that we have seen now is deemed or notional sales consideration. Under that, we have just covered today 2 points: insurance claim and conversion of capital asset into stock in trade. So let us see problems on all these three concepts so that you'll understand the concept better. So yesterday we had completed 3 problems. So today, problem on notional cost of acquisition. Now first, before we start the problem, students, tell me what is notional cost of acquisition? Quick, students, so that we complete it fast. What is notional cost of acquisition? Yes, students. In notional cost of acquisition, we do not take the actual cost of acquisition to the current owner, but we take the cost of acquisition to the that the previous owner has incurred to acquire the capital asset. Is this clear? Okay. So we start problem number 4. Am I audible, students? Yes.
Yes.
Yes, ma'am.
Okay. So we start the problem. Mrs. Parminder has jewelry being gifted on 1/4/2005 by her brother Jitendra. Jitendra acquired such asset for 60,000 as on 1/7/1995. On 1/7/2002, Jitendra has seen a diamond worth rupees 25,000 in such jewelry. So students, first we'll go step by step. tell me, Mrs. Parminder has a jewelry being gifted by her brother Jitendra. So here, which situation is this? Here, can you did Mrs. Parminder receive the asset by actually paying the amount? Was there some cost of acquisition actually incurred by Mrs. Parminder here, or it is for no consideration she has received the jewelry? Students, what is my question is, has the jewelry being received by paying some consideration, or it is received free of cost as a gift?
Free of
As a
cost,
gift.
I guess.
As a gift.
As a gift. So if it is as a gift, then what concept or what provision are we supposed to use? See, if assets is received under gift, then we have to take cost of acquisition of previous owner. Correct? This is a concept that you have to relate and use. Now, next. Now, cost of the previous owner is what? Jitendra acquired such asset for 60,000 as on 1/7/1995. Now, tell me, students, this is a cost of acquisition of the current owner or previous owner? First, the owner was Jitendra. Then Jitendra has transferred it to Parminder for Parminder becomes the current owner. Who is the previous owner?
Jitendra.
Students.
Jitendra.
Okay. Next, on 1/7/2002, Jitendra has given a diamond 25,000 in such jewelry. Now tell me, what is this? Which term is this? If he's fixing some diamond in that particular jewelry, what type of expenditure
Cost
is
of
this?
improvement. Cost
Very
of
good.
improvement.
Cost of to which owner? To the previous owner, because Jitendra is previous owner. Next, on 1/4/2009, Parminder incurred a polish expenditure on such jewelry costing 5,000. Now, what is this?
Expenses.
What is this,
Selling
students?
expenses.
What is it?
Cost of improvement.
Expenses. Expenses, ma'am.
What expenses?
Selling expenses.
No, ma'am. Cost of,
Parminder is the, yeah. Tell me.
cost of improvement, ma'am.
To the current owner.
To the current owner.
Okay, let me tell you, it is not a cost of improvement to the current owner. What is the meaning of cost of improvement? Cost of improvement means anything that increases the value of the asset, anything that improves the quality of the asset, anything that is a capital expenditure. Now, if I have a gold ring and I'm just polishing it, will the value of it increase? This is just you're polishing that jewelry. You're not fixing some, and it is not a capital expenditure. Polishing people do in a year, like whenever there is festival time and when they want to wear jewelry, they polish the jewelry. Okay, so it becomes a revenue expenditure. What is cost of improvement? It has to be a capital expenditure where the value of that particular capital asset has to increase. Now, when Jitendra has put diamond in the jewelry, obviously the value of that jewelry will increase, right? Now, only if
Yes,
you're
ma'am.
polishing it, if you're just polishing that jewelry, suppose if the jewelry costing is 50,000, you have polished it. Will the value increase to 60,000 just because you polished it? Or will the gram remain the same? What do you mean by
Will not
polishing, students?
increase, ma'am.
Polishing? Correct. So, this is just given to confuse you all. You all have to think that, first of all, polishing will not increase the value of the product or capital asset. So it is not cost of improvement. This particular information has to be completely ignored. Okay. Everyone understood it? Okay. Next, as on 1/4/2019, Mrs. Parminder sold such jewelry. So whatever Parminder had got a jewelry as a gift, she's selling it for 12 lakhs. So what is 12 lakhs, students?
Sale consideration.
Very good. Brokerage at 1% of sales value was paid by her. What is this brokerage at 1%? What is brokerage?
Expenses.
Which expenses on transfer? Very good. The fair market value as on of the jewelry as on 1/4/2001 is 2 lakh, 1/4/2005 is 5 lakh, 1/4/2019 is 7 lakh 50. Now from all this, what is relevant that we have to decide? Everything is not relevant. What is it relevant? We have to decide. Next, compute capital gain in the hands of Mrs. Parminder for the assessment year 2021. Students, before getting confused or anything, let me tell you, if you have received, if you have had any case where it is as a gift, will, inheritance, all these cases where you have received, just remember you have to concentrate only on cost of acquisition. Rest other things will remain the same. Cost of acquisition and cost of improvement only to the you have to take based on what cost of acquisition and improvement the previous owner has done. So based only on that you have to do. Rest other things will remain the same. Okay, so let us start the solving the problem. Computation of capital gains in the hands of Mrs. Parminder for the assessment year 2020-2021. So first thing, we have to identify whether it is a short-term capital asset or a long-term capital asset. So Mrs. Parminder is selling that asset on 1/4/2019, correct? And Jitendra had acquired that asset on 1/7/1995. So tell me, students, whether it is a short-term or a long-term capital asset.
Long-term capital asset.
Very good. Okay, so we are indexation is required for long-term capital asset. So sales consideration, we will take it as it is. How much it is? 12 lakhs. Because Parminder is selling it for sold such jewelry for 12 lakhs rupees. So we are going to take 12 lakhs. Okay. Less expenses on transfer. 1% is the brokerage. 1% of 12 lakhs is 12,000. You got net consideration. Net consideration is nothing but after minusing sales consideration with expenses on transfer. Next, less indexed cost of acquisition. Now, students, tell me, in the case of gift, what is the cost of acquisition you are supposed to take? Cost of acquisition to the previous owner, because Parminder to has received it free of cost. So Jitendra had acquired the asset on for 60,000. And yesterday we had learned a concept that if any asset is purchased, is acquired before 1/4/2001, then what is the cost of acquisition you're supposed to take? In my yesterday's lecture, there was a concept that I told you all that if any asset is purchased before 1/4/2001, the cost of acquisition will be the actual cost of acquisition or fair market value as on 1/4/2001, whichever is higher. Remember, in I think problem number 2, we had done that. See here, if an asset is acquired before 1/4/2001, then cost of acquisition will be the higher of the following. Actual cost of acquisition or fair market value of an asset as on 1/4/2001. Correct. So in this case, actual year it is purchased before 1/4/2001 because it is purchased in 1995. Now, actual cost of the asset is 60,000 and fair market value on 1/4/2001 is 2 lakh. So what is the cost of acquisition I'm supposed to take? Which is higher in 60,000 and 2 lakh?
2 lakh.
So I'm supposed to take 2 lakh. Therefore, I have taken 2 lakh rupees. How do we calculate indexed cost of acquisition, students? Cost of acquisition into the index of the year of transfer. So when is Parminder selling that asset? Parminder is selling that asset on 1/4/2019. So we have to take index of which year? 1920. So index, let us see index of the year 1920. Index of the year 2019-20 is 289. So we have taken 289 divided by. Divided by which year's index you're supposed to take, students? Students, which year's index you're supposed to take?
Acquisition, ma'am.
The year of acquisition of the previous owner or current owner? Just now in my concept, when I explained you all, I have told you all that index cost of acquisition in case of notional cost of acquisition means you have to take the year in which the current owner acquired the asset. So which is the year in which the current owner acquired the asset? Mrs. Parminder acquired the asset on 2005. So which index are you going to consider? 2005, 2006, that is 117. So therefore 100 divided by 117. So you get 4,94,017. If you all have forgotten the concept, moving ahead, just showing you all. Okay, in case of notional or deemed cost of acquisition, indexation benefit on cost of acquisition will be available from the year when the current owner first held the property, not the previous owner. So cost of acquisition, you have to take index of which year? The year in which the current owner first held the property. But in case of cost of improvement, when the previous owner did the improvement, from that year you have to calculate the index. So did everyone understand how to calculate index cost of acquisition? Next, index cost of improvement. What is the formula for index cost of improvement? Cost of improvement. Now, what is the cost of improvement to the previous owner? 25,000 into the year of transfer. Index of the year of transfer is 289 divided by index of which year? Of the year in which the previous owner has done the improvement. So which year the previous owner has done the improvement? 17-2002. Means you will see index of which year? 2002, 2003. So that is 105. So you will consider here 105. So once you solve this, you get 68,809. When you add this both, you get 5,62,826. So from the net sale consideration, you are going to deduct the index cost of acquisition, index cost of improvement. Your long-term capital gain is 6,25,174. Okay, now let us see the notes. Fair market value as on 1/4/2005 and 1/4/2019 are irrelevant. This is just given to confuse you all. Next, cost of acquisition shall be taken as cost of acquisition in the hands of the previous owner or fair market value as on 1/4/2001, whichever is higher. What is the reason? Because previous owner has purchased this before 1/4/2001. However, indexation benefit will be available from the year in which the SSE acquired the property. SSE is the current owner. Next, benefit of indexation in case of cost of improvement shall be available when actual improvement expenditure was incurred. Next, polish expenditure on jewelry does not amount to improvement, as such expenditure is not a capital expenditure and it does not increase the value of the asset. So whatever information we have ignored, we have written the reasons for it in the notes. So students, have you all understood this concept of notional cost of acquisition? Concept I had already explained. Now we did a problem on that. So did you all understand what is the difference?
Yes, ma'am.
Everyone, did you all get this problem on notional cost of acquisition?
Yes, ma'am.
Yes, ma'am.
Nothing has changed. Only index cost of acquisition and index cost of improvement. Only the changes is what the previous owner has incurred. We have to consider that. And index of which year we have to consider in case of cost of acquisition. Index of the year in which the current owner first acquired it. And in case of cost of improvement, when actually the year improvement was made, that year index we are supposed to take. So, and there is nothing else that we are supposed to additional in this particular problem. Next, let us see problems on where indexation is not required. So one more concept we have seen today, that there are certain cases where, though being long term, indexation is not required. So let us see a problem on that. It is a very simple calculation again. Miss Isha has 1010% debentures of X Limited acquired on 17/4/2009 for 120 each. So what is this? Which term is this for calculation? Miss Isha has acquired some debentures for 120 each. So what is this, students? Which term is this?
Cost of acquisition.
Cost of acquisition. Next, as on 1/2/2020, she sold such asset for 1,45,000. So what is 1,45,000?
And sale consideration.
Correct. Brokerage at 1% of such sale value was paid by her. What is this?
Expenses on transfer of.
So compute the capital gains. So very simple. Since she is transferring a debentures, first you categorize whether it's a long term or short term. She acquired in which year? 2009, and she's selling in 2020. So whether it is a short term capital asset or long term capital asset? Students, tell me, 2009 year she has short term or long term?
Maybe long term.
2009.
Long term.
It is a long term, no?
Long.
Very good. It is long term. Now, though it is long term, should I apply indexation on this transfer? It is debentures. Here, if you all remember, cases where indexation benefit is not available even on transfer of long-term capital asset. So you all told me it is long-term. So first case is debentures. When you're transferring debentures, even if it is long-term, he will not. The transfer will not have indexation benefit. Okay. So let us start solving. Sales consideration is how much? 1,45,000. Less expenses on transfer is nothing. 0.5% of 1,45,000, which is 725. So net sale consideration is 1,44,275 less. Why are we not taking indexed cost of acquisition and indexed cost of improvement? Because if it is a debenture and if debentures are transferred, though it is long-term capital asset, indexation benefit is not given. So therefore, cost of acquisition we will calculate normally. What is the cost of acquisition? 1,000 into 120. She has acquired 1,000 debentures into 120 each. So 1,000 debentures into 120. So 1,20,000. Cost of improvement is not given. So we take it as nil. So we get 1,20,000. So what is the long-term capital gain? When you minus this both, that is 24,275. Note, though the asset sold is a long-term capital asset, still indexation shall not be applicable as indexation benefit is not available on transfer of debentures. So now we have seen two problems on two different concepts that we have dealt today. We have done one more concept, insurance claim and conversion of capital asset into stock in trade, but which we will be seeing in tomorrow's class since the time is already up. So students, have you all understood this particular? Nothing. What you have to do is solve this problem as you solve normally. Don't use indexation. That's it. Just use the actual cost of acquisition. No need to use the cost inflation index to calculate the cost of acquisition or cost of improvement. So students, have you all understood both the concepts properly? First concept is where indexation not required, and second concept is deemed or notional cost of acquisition. So students, have you all got that?
Yes, ma'am.
Okay. In tomorrow's class, in the next lecture, we will be seeing the sums on insurance claim and conversion of capital asset into stock in trade. So thank you so much, students.